My name is Roxy Guane. I'm the VP of Platform Operations for iFindTaxPro. I'm joined by some special guests. My first guest I'm introducing is John Seeley, who's a corporate finance expert from Acreus Capital. And he's a corporate finance expert specializing in securing working capital, managing cash flow, and restoring financial health. Successfully owned and operated numerous businesses. He's an ex-banker, an asset-based lender, extensive network of lenders in his Rolodex, and he helps businesses access the best financing options. He has a BA from James Madison University and an MBA from Georgetown University. Check out his website, check out his LinkedIn below to learn more about him. Welcome, John. This morning, we are going to rely on you to give us all of the ins and outs regarding equity versus debt financing and what businesses need to know. And our first session is going to be taken by good old John on financing for business owners. So I just wanted to welcome you once again, John. Thank you for joining us, and we look forward to hearing what you have for us.
Thanks, Rox, and hello, Dimitri. So going to go through just the different types of funding. A lot of times, business owners come to me and they're like, hey, I've got this idea. I've got this product. I've got people interested. What do I do next? And a lot of times, the first thing we do is like, well, is this going to be debt or equity? Because if it's just an idea that they have, or they're like, hey, I have this product, product X, and company X or company Y wants it, but they haven't made it. They need money to make the product. That is going to be any equity. Anything that is really before the sales get going is going to be equity. And a lot of times, if they want to that real beginning startup, the best thing to do is go the equity route with friends and family, which I'll get into. Now, if they have a product and they've got sales and they're like, hey, you know what? I've got this revenue and I'm growing like crazy. That's when the debt is really going to step in. So with equity, you got the friends and family money is really the first place that they go. This is where your mom, your dad, ideally are going to step in. They call it a loan, but a lot of times it's a gift. Like, I believe in you. Let's give you the money to get started. Now, if you're further along in the process and you've actually got a company and you're really growing like crazy, and now you want to, let's say, build out a facility to manufacture the product here in the United States or something. A lot of times private equity or venture capital is going to be the way to go. Now, with venture capital and private equity, you're going to have to give up a nice chunk of your company, but it absolutely takes you to that next step and really is oftentimes a rocket launch of success and growth that you would not be able to afford succeed or encounter with just debt. So with the debt, you have there's different types, right? There's going to be kinds with asset-based financing where what you're going to do is use the assets of the company to then leverage and get financing to grow. Almost by definition, any company that is growing is going to run out of money, because what happens is they grow from X revenue to 2X to 3X, and eventually they're just out of cash because they've got to pay their vendors, they've got to pay their employees. And so what happens is they're like, hey, I've got this growth potential, but I'm out of cash. What they'll do is say, okay, well, you have accounts receivable, you've got inventory, you've got purchase orders, you have all these things that you've built up in your company. So the lenders are going to step in and say, hey, we believe in you. We've seen your track record. Now let's get you the money so that working capital is not going to be your problem to hold you back. And so that way, as you grow, you can grow from $100,000 a month to $1 million a month in revenue. And with the debt lending, they will make sure that you always have the capital you need. The secondary way is bank lending. Now, a lot of times, bank lending is best used for a company that is growing pretty slowly, but growing. They're going to have years of profitability, and that bank lending is often going to be the cheaper financing, but it's going to the company's going to have to show years in the past of success, especially profitability, whereas asset-based lending doesn't need to even show any years of profitability, just years of growth, and especially projections of growth. Now, an SBA loan, which will, under bank lending, is a really great mixture of the two, because what the SBA lending does is allow the borrower, the business owner, to leverage the assets of the company and maybe personal assets to get what would be cheaper financing that could be used for either growth or expansion. But also it's going to be based on the projections, whereas bank lending, let's call it traditional bank lending, that is going to be looking backwards. SBA lending does look forward at what you're going to do. Now, due diligence is going to be somewhere where the borrower, a lot of times that's where they make their mistakes. And I'm sure that Dimitri can attest to the fact that the company financials are the most important part of the due diligence process. And without a good accountant, bookkeeper, etc., a company is going to flounder in this part of the due diligence. A lot of times the business owner, they're wearing a lot of hats. Maybe they're the ones even putting their books together. And the lender wants to know, it doesn't matter if they've grown, if the company's had profit or not. What they want to know is that the financials are absolutely spot on. And so the owner is going to have a good credit score. They're going to need to have the good tax returns, personal returns. But most importantly, the company is going to have to show, I call it the four things: their assets, their debt, their profits, their revenue, and then their profits. These are really shown by the company's financial performance, but also, especially with asset-based lenders, the company's customers' quality is going to be a huge part of the qualification for the company to borrow money. Because if the lender is using that company's assets, a lot of times, especially if the assets are going to be accounts receivable or purchase orders, it's the invoices to whom the invoices are from or to, right? So if the customers are solid, then invoice financing is going to be a strong possibility. And again, we see a lot of drastic increases in revenue with the asset-based lending, because the only thing holding it back was the financing. And so a lot of times the borrower comes in and says, I've got these purchase orders, I've got these contracts, I need the money to make them happen. And that's what excites the lenders. But they really need to show that they have a track record of sales, but also they show the professionalism of having strong financials. So what they look at when the lender is looking at these financial statements, it's like, well, where's the money going to come from? What are the assets of the company? Is it going to be the owner's personal assets? Is it going to be the accounts receivable, inventory, machinery, equipment of the company? And what are they going to use it for? If they're going to use it for paying off debt, that's not as exciting, right? That's not really showing growth, unless it's maybe paying off credit card debt or something that is really hurting the bottom line. What really makes them excited is the working capital or even expansion. They want to lend to a company that's going to grow from X dollars to 2X, and hopefully pretty rapidly. But then the final question is there enough money that the company's making? A lot of times, especially startups, they just want to get that big deal. They want to get that sale. And they might do it at a small margin, just like, oh, look, we got this deal. And then it's like, well, how are you paying your workers, and how are you paying your vendors enough money? How do you make enough money to live on, but most importantly, how are you making enough money that's going to pay back this financing that we're getting for you? So, and this goes back to the financial statements. I had a client that they thought they had a whole bunch of money. They're making great profit because they had $4 million of accounts receivable. Well, when you broke it all down, they had like $4 million of debt. So they, which they had built up because they had been borrowing money because of the cash flow problems. So it turns out that after 3 years, the owner did not even know that they weren't making money because they just saw that money was coming in and look at all this accounts receivable, but they didn't realize that their profit margin was very, very slim, if not zero. And that goes back to the quality of the financial statements. So the challenges for business owners, especially recently, a lot of owners are still suffering from COVID. They had that decline, and now they're picking it back up. But especially with banks, what the banks are looking at as well, you lost money 2 years ago, 3 years ago. And even though it's because of a legitimate reason, they're still nervous about lending to companies that have had losses in the past. Whereas asset-based lenders really don't mind as long as there's a legitimate reason for that loss. And how's the recovery been over the last year or two? And what are the projections? Now, one thing that's been happening with the recent political changes that are changing the economy, tariffs has been the number one issue. I recently had a client that had been approved for financing from a bank, and then just about a week ago now, like in February, the banks came back and said, well, with these tariffs, because my client, I apologize, back it up. My client was importing from Asia, and now the bank was like, wait a minute, with these tariffs, they plugged in like a 30% tariff that has not yet gone into effect, to my knowledge. At least it had at that time, but the fear of it, and they said, well, you're not going to be making enough money now with these tariffs, because as we learned from previous tariff increases, the seller in Asia increases the prices. We are the ones that really eat that tariff. It's not like the prices stay the same at X dollars and we still buy it at X dollars and now there's a tariff that they pay. They increase the price of the product, so the American company pays that X plus the tariff. So, so the bank was like, even though it hasn't been in effect yet, the bank was like, well, we don't know what's going to happen. So the bank rejected my client at the last minute purely because of these tariffs and the unknown about that. And so then, because of what's going on, it's the unknown that the banks are most scared of, right? As we're talking about with like the government saying this, that, I think at one point the banks were not allowed to like really receive money from Chinese companies for a while because of the unknown, and the government was like, hey, they're stepping in. And again, I'm not trying to make this political at all. It's just a fact of the
reality.
Right. That's coming in. And so what's happening is that a lot of these companies that import from Asia are being second guessed or given a second look, but not in a favorable way because of the fears of these unknown directives that are coming. But again, the biggest challenge, as I spoke about earlier, has been the professionally prepared financial statements. Another recent client I had, we're looking at the financials, and it's like, wait a minute, where's your accounts receivable? And they're like, and they had this excuse that, well, it's kind of an inventory. And it was like, well, where is it? Well, we have a separate tracking over here. It's not on the financial statement. And it's like, no, you need your financial statements prepared. And again, this is where Dimitri and his group really could step in and say, and get it professional so that the bank or any lender that looks at it can't be having those questions. They can question, how come you're not profitable? That's fine. But if they question, where's the money here and why is it all confusing and this, it's that reason that another client got turned down, and they said, look, go get professionally prepared from a CPA, get those financial statements, and let's wait 2 quarters, 6 months, and see how you're doing, and make sure that we have 2 quarters of CPA prepared financial statements. And again, it's because the business owner, oftentimes they're doing it, they're using QuickBooks or something, which is nothing against the service, but they're doing it on their own, and they're not they're saving money by not having a professional bookkeeper or accountant, and that's where they really fall into a quagmire. So just to summarize,
can I ask you a quick question? What do you usually see the level of assurance from a CPA for a loan? A typical loan. Do they require audited statements, or as far as we can see, it's okay if it's just compiled or
great
reviewed?
question. Right now, for the size of let's say a few million, and this is why I'm more talking about the startup for this part. But if it's reviewed or compiled by the CPA, that's going to be good enough. When we get into if there's a quagmire like this one, they might want this one audited, just because at this point they've already shown their hand. So at least this bank would probably require audited, whereas if we go to another bank, we'll have compiled or reviewed. But mostly, especially right now, considering the mess of this exact client, compiled is going to make it better. Especially for me, I as a consultant, I want to have faith that these financials are solid, and so I know that the lender is going to want to make sure that that's the case. But when CPA has a stamp of approval on it, that's going to be huge deal for the client. Yeah.
And John, I think a key thing with lending is risk profile. Can you just maybe shed a bit of light on the different stages in the company and the risk that inherently come with each stage, and the type of funding that you would get access to based on the stage you are and the risk that each stage presents?
The number one risk for any lender is fraud. And so a lot of times what really comes in is checking out the owner and what has the owner done, and how good are the customers and how good are the contracts. And by that I mean, like, if the owner has a house with equity that they're like, I will put this on the line, then that speaks volumes to the lender. Not that they want the house, not that they want to take over that, but it speaks volumes that the owner has faith in their company. And then, they have, documents that they sign that says, like, we will not commit fraud. Because one thing, I can't believe it, but a lot of times what a customer will do, a borrower, and again, when I say a lot of times, the number one fraud is submitting invoices that aren't actual invoices. They will say that Acme company is buying X widgets, and the lender will lend money on that invoice, and then it turns out that they didn't sell widgets to that company, and a lot of times the borrower is doing it to try to. It's kind of like they think that if I get this money and I fix this problem, I will repay that. Like, they're not doing it to get the money and run away. They're doing it because they're like, oh geez, I'm in a hole. I got to pay my
in survival mode.
Right. And then it starts exasperating, right? It's like someone going to the casino and it's like, well, if I just double down, right, I'll get my money back and I'll be good to go. And it just exacerbates the problem. And so the lender was going to look at that. And also the lender is going to look at how many times have you been selling this product? So if the borrower has not really been selling this product, then the lender's going to be like, well, let's wait until you have a few sales and they can show that they've got sales and they've received payment for that. Because a lot of times they're like, hey, this is my first time selling these widgets, and I have this invoice. Well, we don't know if the company is going to like the widgets, because if there's no previous sales, we don't know if maybe the company is going to just return the widgets because they don't like them. Because if the lender advances on the invoice, and then the company, the borrower's customer says, you know what, I don't like these widgets, and returns them, then the lender needs to get their money back somehow. And it's not going to come from, the borrower is not going to readily return that money. So did I answer the concerns to your sense?
Yeah, I think you did, John. I think the key thing is understanding the risk that you present as a lender or as a borrower to the lender. And I think that's critical. But maybe a more pointed question is, where do you fit into the ecosystem, and what do you provide to business owners that is different from direct lenders? So, for example, why should they call you instead of just going to the bank for financing?
Great question. A lot of times my clients have gone to the bank and the bank has said no. And so then the bankers call me and say, hey, John, we weren't able to help these people. But the reason to come to me is that I know all the bankers and the lenders, and I know them throughout the country. And what I do is I work on behalf of the borrower. So I'm not trying to pitch my deal. I'm compiling the deal, their deal, and sending it to bankers and lenders at the same time. So concurrently, we're getting offers in from all over so that we really see what the market is going to provide. So if no bankers want it, that's the market's showing that no bankers want it. I had one prospect come to me. They had gone to 13 bankers. And it's like, you would think after 3, they might have learned their lesson, right? But they went to 13. So what I bring to the table is a one-stop shop. I take it off the table. A lot of these business owners, they're wearing more than one hat, as I mentioned before. They need to focus on growing their company. They can't deal with calling out to 10 different lenders, filling out 10 different applications and whatnot, submitting all this, and then tracking where it's all, who they're having conversation with, et cetera. I can do all that for them. And kind of get into one of your questions that in my write-up, I have 3 points. I call it the good, the bad, the ugly. I say, here's what's good about this company. Here's what's bad. And here's what's ugly, right? Like what is it that, if you're going to say, I don't do this, like, for example, and ugly is like cannabis. Some lenders don't like cannabis at all. Some people don't like construction. Some people don't like certain things where, like, there's that, right? Maybe it's they've lost money. They lost $2 million last year, right? And then after I go the good, the bad, the ugly, one of the things is that then I have, here are the mitigating circumstances of the good, right? Which is they're growing. Here's their projections. Here's bona fide contracts that they have from their customers that show what they're selling and how much they're selling it for over the next 6 to 12 months. So I try to, in a one-page executive summary, I make it so that the lenders look at, here's a nice summary of the good, the bad, the ugly. Do I want to even go further with this? And so my lenders, they like getting an email from me because they only have to spend a few minutes to see if they're going to spend more time, right? But then I've packaged up the deal. I'm like, here's these financial statements, the ones I mentioned before. Here's these, right? Including the bank statements. Now, this backs up my summary. Now are you interested, right? So this way my lenders can go through and quickly discern whether they like it or not, and they get back to me quickly. And again, I'm able to send it to 30, 40 different. I had one deal. I did send it to 40 different lenders. I got one. You only need one. but I got him a great deal, and I got him $13 million. And a lot of it this was during COVID, and a lot of banks and lenders had pulled back during COVID. So, for me, I sent it to 40 lenders. No business owner wants to send it to 40 lenders, right? But also, what I'm able to do, I work with the lenders and get the best deal possible. So if Acme calls, Wells Fargo and says, "Hey, I want some money," or another lender, they're just a one-off for that bank or that lender. Whereas I'm dealing with them and I'm talking to oftentimes the credit officer, and I'm like, okay, can't you do better than that? Right? Here's what's going on. And I oftentimes bring from the offer to the final, it comes down, in almost every case, it's come down more than what my fee is. And I charge just a few points on the success of it. And I don't get paid unless they get the money. So my clients don't have to worry about, what, man, I paid all this money and I'm not sure if I'm going to get it. I'm on their side. So
Right.
they know that I don't earn anything until they get the money from the lender. So,
Right. Wonderful, John. And just in summary, what is the lending market looking like? Is there light at the end of the tunnel? What is the current climate?
right. The banks, I feel, are not very eager to put money out, at least not this year. And the thing with banks is they have all these borrowers now that they're actually now spending all their time going to these borrowers and saying, "Hey, how is everything going? Are you okay?" And checking in on them, and not putting out new money until this. Are there going to be tariffs? Yes, no. Like, how much is the tariffs going to be? And not just the tariffs, but other aspects. And so the banks are going to be really tough for at least the next year. Lenders are actually even busier, which makes it a little tougher to get the attention of the lender, because they're like, a lot of them are moving up. Like, instead of doing like, 5 million, now they might be like, what, we won't really want nothing less than $10 million, because the banks are saying no. So it's increasing the demand for the other alternative lenders. So the money is out there, though. The lenders that I deal with, they have money, they are lending. And if a company has growth, regardless of their past, if they're showing growth and their projections show really taking off, it's absolutely a good market for alternative lending.
Yeah. Wonderful. I think that's a nice summary of the lending market, John. And obviously, we would love to unpack more. And time is obviously a challenge. We've gone through the questions, but if anybody wants to contact you, John, where are you reachable? Who should contact you? What should they contact you for?
Yeah, any company that's growing, is our ideal. The best is the B2B businesses that are selling, and somehow, like, a lot of times you see it really take off in a slow. It kind of goes like this, and all of a sudden it's like word of mouth spreads. And again, I had a flooring company that went from 100,000 a month to $1 million a month within a year. That's some serious growth, and their only thing that was holding them back was the financing. And the owner, multimillionaire, he had put in $4 million of his own money, and then he's like, all right, now I'm out, right? Like I said, any company who's growing is going to run out of cash, just because his accounts receivable became about $4 million, right? And that's just the accounts receivable. Then he's putting money into inventory, which was about $3 to $4 million. So the company had 15 million of assets, and that's money that's tied up. And so we were able to get financing, both trade finance and inventory financing and accounts receivable financing. 3 different types of financing that we were able to provide for him as he was growing. So a company that's really growing and saying, oh my gosh, the only thing holding me back is money. That is a great person to call.
Perfect, John. So you work with everything from startups to established growing businesses.
Right. I had one client that they had an order from a pet conglomerate, and they had the purchase order, and I was able to get them the purchase order financing, which then also turned into accounts receivable financing. And they grew, and they became, within 3 years, they became a 12 million in revenue for the year from the first order that I helped them get financing for. So that was one of the ones I really liked, meeting these people. I'm meeting the people, like I'm dealing with a man or woman that started the company, they're growing the company, and to watch them grow, like I'm not just helping someone get rich quick or something. I'm helping a company that, and a business owner that's like, just a regular Joe Schmo, so to speak. And there's just watch them take off. And it really is pleasant to watch them grow so fast, especially when they're calling. I just need the money. I got all this potential. And so, yeah, as long as they're growing and anywhere in the country, any industry, we can help with construction, medical, and cannabis, which are the 3 tough ones. And I've had clients out to New Hampshire, Hawaii, Florida, and Alaska. I had one. It was a flight company. It was an air hospital, hospital in Alaska. So anywhere in the country, and I can go as high as there's no limit because I have lenders that do 50 million. I have lenders that do 1 million, and the 50 million lender does not deal with $1 million deals, and the $1 million lender does not deal with 50. But that's why I like being a consultant, because if you need 20, I've got these lenders. If you need 2, I've got these lenders.
Fantastic. Well, John, that was very enriching. I think there's a lot to unpack there. But just remember, contact John if you need more information and a bit of hand-holding if you're raising funds at the moment. Reach out to John and Aquarius Capital. Details are on the screen. And also, you can drop us an email at info@iFindTaxPro if you need us to send you this information. So, John, thank you. That was enriching.
Thank you, Rob.
I just want to encourage everybody to follow us on iFindTaxPro. We're at iFindTaxPro on all the major platforms. Please comment, like, and subscribe to this episode.